And Dr. Anupam, please take over as moderator.
Okay. Good evening, friends. We welcome you all to the journey to your financial freedom. Dr. Harpal had given a very nice introduction to financial markets and talking about why we should invest in the market or invest actually. And it was very clearly said that there are basically four instruments as per Welcome guidelines where we can invest, which is gold, real estate, equity, and debt. So these can be done actively or passively. So active investment is when we ourselves are actively doing it. Passively is when we allow somebody on our behalf to do it. So one of the investment modalities is mutual funds. And today we had conducted a poll on the group asking people so out of 539, around 110 people had voted in the poll. 60 have said that they invest in the mutual funds directly on their own. 43 people have said that they invest in mutual funds through an agent, and 6 have voted that they do not invest in mutual funds at all. So today we will be discussing mutual funds. Dr. Vishal Garg from Ludhiana, he shall be sharing his views on mutual funds and explaining how we can invest in mutual funds and what are the different types. So over to you, Dr. Vishal.
Yes, good evening, friends. Welcome, myself, Dr. Vishal Garg. So this will be a very basic talk on mutual funds. जो ਆਪਾਂ ਹੁਣ ਇਕੱਠੇ ਹੋਏ ਆ ਸਾਰੇ ਵੀ ਸ਼ੇਅਰ ਮਾਰਕੀਟ ਬਾਰੇ ਸਿੱਖੀਏ ਤਾਂ ਆਪਾਂ ਮਿਊਚੁਅਲ ਫੰਡਸ ਕਿਉਂ ਡਿਸਕਸ ਕਰ ਰਹੇ ਹਾਂ
Dr. Vishal, I think you should use either Hindi or English because many would not understand Punjabi, I think.
Okay. So,
and preferably in English because there are many people from South also.
Yeah. So we are discussing why we are trying to learn mutual funds when our main purpose is to learn the share market, learn how to invest in stocks. So if you know how to drive a car, then you drive a car. That is share market. But if you don't know how to drive a car, then you travel by bus. You believe in the driver of the bus to carry you home. So that's the difference between stocks and mutual funds. How does mutual fund work? So investors pool in their money and the fund manager invests your money into securities and generate returns, which are passed back to the investors when you redeem your investment. Dr. Anupam, I am audible?
Yes, sir, loud and clear.
Okay. So what are the benefits of a mutual fund? You can invest any amount from 500 onwards. So low investment minimum, liquidity is there. You can redeem your investment at any time. Within 2 or 3 days, you can get your money back. Your investment is diversification. If you're investing small amounts like 1 lakh, 2 lakh, 5 lakhs, it is difficult to diversify into different sectors, into different stocks. But if you invest into a mutual fund, suppose a diversified mutual fund you are investing, the money is diversified into various classes and various sectors. And we believe that a professional person, a trained professional person is managing your money. We are not making mistakes on our own. So the mutual funds, they help in managing inflation. Usually inflation is 5 to 6%. If we keep the money in an FD, we get 6-7% returns. And after taxation, it is hardly 4.54 to 5%. But mutual funds are generally expected to generate around 15% returns, which help us manage the inflation. The expertise of the mutual fund manager is there. It is very convenient to use the mutual funds, invest in mutual funds. Their economical means very small amounts can be invested. So once you go in for mutual funds, the first thing you come across different classes of mutual fund. What are different mutual funds? And NAV of the mutual fund. What is NAV? The total assets minus liabilities and expenses divided by outstanding units, means value of one unit of mutual fund is NAV of the mutual fund. What are the various types of mutual funds? They can be equity funds, debt funds, money market funds, hybrid funds, gold funds. We will be discussing it further. So they can also be classified according to the structure of the mutual funds. They can be open-ended or close-ended, or by investment objective, equity, debt, money market, gold. Open-ended and close-ended. Some funds have a locking period of 3 years, 5 years. You invested in the mutual fund at one time and you can redeem only after 3 years or 5 years. Those are close-ended mutual funds. While open-ended mutual funds, you can invest at any time and redeem at any time. So we are discussing equity and debt mutual funds. Equity mutual funds are those which are investing more than 65% of their money into equity or arbitrage funds. While debt funds are there, which are investing less than 65% of their money into equity, and they are investing more into debt, gold, or liquid funds. So even equity funds can invest some money into debt funds, into debt instruments, and debt funds can also invest some amount into equity funds. So taxation of mutual funds, this year they have changed. So short-term capital gain, if you redeem a mutual fund within 1 year, you are taxed at 20%. While long-term capital gain is, if you redeem the mutual fund after 1 year, then up to 1.25 lakhs, there is no tax. And if the gain is more than 1.25 lakhs, over and above the amount will be taxed at 12.5%. Same here, debt funds. Debt funds were earlier having some tax advantages, but now the taxation has been changed and there is no long-term capital gain benefit. That debt funds are taxed according to slab, your tax slab only. So now coming back to the equity funds. What are the various classes of equity funds? They can be diversified equity funds, large cap, mid cap, small cap, or sectoral, catering to a particular sector. You can go into banking sector, FMCG, pharma, technology, and there are other classification, thematic, theme-based mutual funds, energy sector, PSU can be in various other categories also. Dividend yield, the companies which are giving good dividends, some funds are investing into high dividend yield stocks only. So diversified equity mutual funds are expected to give 10 to 20% return annually. So what is large cap, mid cap, small cap? Large caps are big companies, top 100 companies. Mid caps are 100 to 250. These are what are top 100 means. According to market capitalization, the top 100 companies are large caps, 100 to 250 are mid caps, and 250 onwards are small caps. Generally, large caps have the market value more than 10,000 crores, mid cap 2,000 to 10,000 crores, and small caps up to 2,000 crores. But this is not a fixed definition. The main definition is top 100 companies is large cap. So usually we should invest more into large caps because large caps are more stable. Small caps can give you more returns, but they can some of the small cap companies can also disappear. So 50 to 60% should be invested into large caps, 25 to 30% into mid caps, 5 to 10% into small caps. Rest according to your risk appetite. Equity linked savings schemes are of vogue these days. Debt funds, those were equity funds, now debt funds. What are debt funds? They invest into government bonds, corporate bonds, banks, etc. Some portion they can invest into shares also. They are less volatile and can generate returns of 8 to 12%. But sometimes we think that debt funds cannot generate negative returns. They can also generate negative returns. Now, what are the different plans of mutual funds? Mutual funds can be direct versus regular, growth versus dividend, open-ended versus close-ended. Now, direct funds are those when you invest directly into mutual fund without using any agent. And regular funds are the funds when you invest through an agent and you have to pay 1% or the commission of the agent. Then mutual fund schemes are also having growth or dividend. So growth is all your money generated is being invested, invested into the mutual fund, and you are trying to achieve good growth, high growth. Well, dividend funds are there where regular dividends are paid. Some amount is being returned to you regularly on regular basis. Open-ended versus closed-ended, I've already told. Open-ended, you can invest at any time, redeem at any time. Then closed-ended have some lock-in periods. So, what are the differences between direct and regular plans? As I already told you, direct plans you invest without involving distributors or agents, and expense ratio is lower because the expenses of distributors are decreased. They generally generate higher returns because the cost is less. But investors have to do their own analysis, and NAV of direct plans is usually higher. So you can see here what are the benefits of investing through direct funds versus regular funds. The lower graph you can see if you have invested in the same fund through direct method, then the returns can be 81% higher over a 40-year period. So you can see that your money has almost doubled. Even when you were thinking about only 1% commission to the agent, but due to compounding, the results over years are astronomically different. So what are the expenses of mutual fund which are eating into your money? Usually the management fees is 0.5 to 1%. There are administrative costs, distribution fees, ads or promos. Mutual funds spend on these also. Now other option was growth versus dividend. All the money in the growth fund, all the money is invested until redeemed. Well, dividend options, there is a payout in the form of dividends, and you can get regular, monthly, or dividends are declared by the dividend funds regularly. Dividend funds are suitable only for people who require a steady income flow. Difference between open-ended and closed-ended mutual funds. Open-ended can be redeemed anytime. Closed-ended have a fixed lock-in period. But the benefits for the mutual fund manager is in closed-ended, he is not under any pressure, any redemption pressure. So he can rotate the money according to his knowledge. But in open-ended funds, if there is some market crash or some fear scenario is there, people can redeem the money, and the fund manager may have to sell some of the stocks at abrupt times because the people are redeeming too much money, and his freedom is decreased. So sometimes closed-ended funds generate better returns because the if the fund manager is intelligent, he will have more freedom to invest the money according to the current scenario. So there are different types of fund which you can choose. Growth funds, large cap, mid cap, small cap, flexi cap, etc. Then if you need to protect your money, you don't want to risk your money according to the market risk. So you can invest into arbitrage funds, liquid funds, which can give 6 to 8% return. There is other category, balance funds. In balance funds, some amount is invested into debt instruments, other is invested into equity funds. So the money is balanced. Some percentage is debt, some percentage is equity. So they give an average return of 8 to 10%. Hybrid funds are there. So balance funds can be equity oriented, can be debt oriented. They can be having more of equity or more of debt. So mutual funds can be invested through financial advisor, through a broker, through a bank, or you can buy mutual funds online. Whenever you invest through any agent, he is given a commission of around 1% to 2.5% by the mutual fund, and your returns decrease. So we always advise to invest in mutual funds by direct methods only. So you can invest through various sites also, common platforms, MFU, Zerodha, people are using Paytm, KT Money, Grok, Vera. So you can use any of these sites to invest into mutual funds. Few mistakes you need to avoid while investing in mutual funds is investing without a plan. Trying to time the market. Whenever you try to time the market, most of the time you lose money. Don't try to be too intelligent. Frequent reshuffling of the funds is also bad because you pay more of commission, exit lots are there, and lines change करते रहोगे तो आप हमेशा पीछे ही रह जाते. Panic exit. Like recently there was a panic regarding war situation. The war situation, geopolitical scenario changed overnight and the market is up again. And investing into too many funds. You should keep 5, 6 funds only which you can track. Do not invest into 20, 30 funds which you cannot track. So takeaway points, you should always invest in direct and growth plans. Arbitrage and liquid funds are better than bank FD because of the taxation benefit. SIP is good. It is automatic, effortless, systemic investment. SIP, you invest regularly 5,000 per month, 10,000 per month. And equity mutual funds and debt funds are different. For safety, you can go into debt funds. For growth, you can go into equity mutual funds. Now, detailing more about SIP, that is systemic investment plan, where you regularly put money, like you choose a date, 5th of every month, you are investing 5,000 a month into some specific mutual fund. If the market is high, you are getting less number of units. But if the market falls, the NAV decreases, the same amount, 5,000 of amount is buying more units. So indirectly, you are able to buy more units when the market is low. So SIP is a very good investment and gives you good results in long term. Now, once you invest, when you're trying to invest, you open the site like this. I have opened the site of SBI mutual funds. You will come across these 4 options. You can see like direct growth is there. Around that, there are 4 options. Direct annual IDCW, that is dividend only. Regular IDCW or regular growth. We have to go to direct growth option only. You don't want to invest into dividend option or regular option. Lump sum or SIP, that is your wish. If the market is low, you can invest lump sum, but long-term SIP is always good. When we need to invest into debt funds, we are discussing equity funds for growth, but debt funds are also important. When you have short-term investment horizon, when you know that you are needing the money within the next 6 months or 12 months, market is growing, everything is okay, but you don't know geopolitical scenario or market risk. Anytime something happens, the market falls, and you go for redemption, and the market is at a low point, so you are not making good profits. So once you are sure you are requiring money within 6 months to 1 year, some of your funds should be kept into debt funds, which are safer, and you know that you can redeem this money at any time. And this is an emergency fund. Or sometimes you are waiting to decide. After receiving you suddenly received some amount. Like present scenario is there. Market will grow, but there are some risks due to geopolitical scenario that market can fall. So you can keep some of your money into debt funds, and if the market falls, you can enter into equity funds at that time. So one more thing, arbitrage funds. Arbitrage funds are one of the safest mutual fund. They are hedge funds. They hedge your money and they generate return of 6 to 8%. Their returns are better than bank FDs because anything you Any gain you receive in bank FD is taxed at 33% bracket, but these arbitrage funds will be charged according to the equity taxation, that is 20% short-term gain, and long-term gain is 12.5%. Now, few terms you should know: CAGR, compound annual growth rate. So, at an annual compounding, what percentage, what interest rate is being generated by your investment? If you invested 10 rupees 5 years back, it has become 20 rupees after 5 years. So it has doubled. But what is the actual growth rate every year that it is generating? Because doubling looks very good, but if that 10 to 20 years happened in 8 years, your CAGR will be lower. So you should always calculate. These are the calculations, formulas. You can apply in Excel also. Initial amount and the final amount that has become after 8 years is this. You can apply this formula. It is written over here. You can see it, and you can apply it in Excel. You will get to know what is the CAGR returns of your investment. Then IRR and XIR. Internal rate of return is the interest rate received from an investment with payments and income coming at regular intervals. While XIRR is extended internal rate of return, when the return, when multiple investments are made at different points in time. So this was a brief about mutual funds. I can give you a demo about how to select mutual funds also. Dr. Anupam?
Yeah, I think excellently presented, sir. I think we can just sum up first what was your presentation and discuss what is the basic main uh, just give a gist of what you are trying to convey by this. What are the mutual funds? What is a mutual fund? What are the types? And how you should invest in mutual funds?
Mutual
And then
funds
we
is
can go on to the demo.
any questions, and I'm just repeating the brief summary. Mutual funds, then you don't know details of the market. You're investing through a fund manager. You're giving your money to a fund manager who's investing on behalf of all of us. And he is supposed to be financially literate and investing in a better way to generate us returns. That is mutual funds. And there are various categories: equity, debt funds. In equity, there are diversified funds, theme-based funds, sector-based funds. You can invest in different types of mutual funds also.
And how to invest?
You can invest through various platforms. Most of people are using this Zerodha. You can go through MFU also. You can uh, uh, go to direct AMC sites. Like I have shown SBI mutual fund site where different four categories were written that you can want to invest through direct or regular fund. So you can go to AMC sites also, your brokerage portal also, but always see to choose the direct option that your brokerage may not charge the commission.
Yeah. So basic idea is to always choose the direct option and growth option
Yeah,
whenever
correct.
we're investing because it leads to even a 1% commission over a long-term period leads to about 80% loss of returns
40 over 40
over
years,
40
there was
years.
81% gain in the returns with direct option.
So, any questions right now do you want to take or do you want to see how to select a mutual fund?
Anybody from the audience?
Anything, anybody who wants to ask any question, query, you can just raise your hand and we can take a question. Otherwise, I think we can just, Dr. Vishal, we can just see how to select. I think most of us want to understand how to select or what are the
How
criteria
to
for
choose?
selection.
So we use value research online portal.
Your PPT is visible. I think you need to share your screen
Okay, I
again.
will change the sharing.
So by the time you change, Dr. Sudhanshu's question is, when do you shift the fund? And what is the time to switch to some other fund? So Dr.
If your
Sudhanshu,
fund is
by the time Dr. Vishal loads his thing, uh, it's not that you are passively investing through a mutual fund manager, means he's taking care of the investments for on your behalf. Doesn't mean that we will not track what the mutual fund manager is doing for us, and we need to regularly keep a tab, maybe 6 months or 1 year. Dr. Vishal said, do not shift frequently because that will lead to a loss, but at least an annual review of what your mutual fund is doing, whether we are invested in the right mutual fund. If there is any bad news or something that needs to be watched out for, and if we find that the fund is not performing well over a time period, means progressively it is not performing, then we may think of shifting the fund. I hope that is your query has been answered.
So why do you want to shift? If the fund is performing well, you don't need to shift. If there is some very bad news, it is not performing, then you need to find better opportunities, then you shift. Otherwise, there is no need for shifting.
ठीक है सर. Okay sir, I got it.
Any other question? Is my screen visible? That value research online?
Yeah. Yes, please go
So
ahead.
I have just opened valueresearchonline.com and then I've gone to the funds. Then I go to fund screeners. Everybody can understand this?
Yes, please
we
go
need
ahead.
we need to screen the funds. Which funds we want to use? Which fund is better for us? हाँ जी डॉक्टर मोदी, कुछ मैं बोल रहा हूँ वो आपको ठीक लग रहा है? समझ पता लग रहा है?
Yes, everything is okay. Continue.
So fund screener. Once you open the fund screener, this I have already chosen equity flexi cap, fund house. These are the various options: fund house, fund category, value research rating, other filters. So fund house, we are not concerned about any single fund house. Fund category. So let's go for large cap. We are searching for large cap funds. We delete the flexi cap and apply. We are also going to get the value research rating, and we are allowed open-ended, close-ended both. We have gone for direct funds search. So these are the various funds we have got. We need to get, what are the things we can see in this? We are getting 1 year return and the rank of the fund according to value research. Risk-o-meter is very high because these are equity funds. Risk-o-meter is high. Expense ratio, we are getting the expense ratio also, and age of the fund. The fund is how many years old. So while choosing funds, we are using also care criteria, CAARA, care criteria. What is category of the fund? What is age of the fund? What is AMU, under management? What is the rating of the fund? Returns of the fund? So we need to see, we are not interested in the fund which is only 6 months old because its history cannot be traced. So we are looking for funds which have age of at least 3-4 years. And the returns are written over here. In value research online, you can touch this 1 year return rating. We want to see the funds according to the best rating. So can everybody see? I have changed the list according to the ratings. Is it visible? Dr.
Yes,
Anupam?
go ahead. Yes, go ahead, please.
Yes.
So you can see the first rated fund is Motilal Oswal Large Cap Direct Fund, which has given 26.23% returns in the last 1 year, ranked 1 here. And the expense ratio is 0.8 age is 1 year 3 months only. So usually I go for top 10 funds. You can export this to Excel sheet, and top 10 funds I'm interested in. Now you can change, you can see the 3 years and 5 years return also. I will show you. Yeah, returns. Oh, this is a snapshot of the uh, classification of these mutual funds. Go for returns. I go for long-term returns. So मैंने पहले वो 1 year रिटर्न से टॉप 10 फंड्स की लिस्ट बना ली. अब मैं लॉन्ग टर्म रिटर्न्स देख के 3 ईयर 5 ईयर 10 ईयर रिटर्न्स की लिस्ट में जाऊंगा. यहां पे भी मैं रैंकिंग में सेम काम 1 to 10 कर लूंगा. नाउ आई विल ट्राई टू मैच कि मेरे 1 ईयर रिटर्न 3 ईयर 5 ईयर रिटर्न्स में कौन से फंड्स बार बार रिपीट हो रहे हैं. कुछ फंड्स ऐसे होंगे जो 1 ईयर में होंगे लेकिन 3 ईयर में नहीं होंगे. जैसे इसमें आया भारत 22 ईटीएफ. ये 3 इयर्स में भी नंबर 1 है, 5 इयर्स में भी नंबर 1 है, 10 इयर्स में नहीं है, मतलब 10 इयर्स में होगा ही नहीं, इसकी एज ही कम होगी. सो हमें क्या देखना है इसमें 1 3 5 10 इयर्स की रिटर्न देख के एक और तरीका मैं यूज करता हूँ. 1 ईयर रिटर्न, 3 ईयर रिटर्न, 5 ईयर रिटर्न, 10 ईयर रिटर्न, टॉप 10 की जोड़ लेता हूँ. तो जिसकी रिटर्न सबसे ज्यादा आती है उसको मैं कंसिडर करता हूँ. उसमें फिर सेकंड पॉइंट हमें क्या देखना है, एसेट अंडर मैनेजमेंट at least 2000 crore. If the fund is too small, value of asset under management is only 500 crores. A big investor comes and certainly redeems 100 crores. तो फंड मैनेजर को इमीडिएटली बहुत सारे अच्छे स्टॉक जिसमें वो सोच रहा है कि अच्छा रिटर्न आएगा वो भी बेचने पड़ सकते हैं. बट अगर फंड 10,000 करोड़ का है, कोई इन्वेस्टर 100-200 करोड़ भी निकाल ले तो उसको बहुत ज्यादा फर्क नहीं पड़ता. तो टॉप 10 फंड्स में से हम शॉर्टलिस्ट कर लेते हैं कि 1 3 5 10 जोड़ के कौन से बार बार आ रहे हैं, तो उसमें हमारे पास 4-5 रह जाते हैं. उसमें से फिर हम देखते हैं कि एसेट अंडर मैनेजमेंट किसके ज्यादा है और किसका रैंक ओवर 10 इयर्स 5 इयर्स 3 इयर्स 1 ईयर इंप्रूव हो रहा है या एटलीस्ट डिटीरियोरेट नहीं कर रहा. सो दीज आर. और उसके आगे फिर और आते हैं सोटिनो रेशो, चापे रेशो वगैरह आते हैं, वो दूर की बात है. सिंपल आप 1 ईयर 3 ईयर 5 ईयर 10 ईयर रिटर्न्स देखो. टॉप 10 की लिस्ट में से जो रेगुलरली हर आपके साल में आ रहे हैं बार बार, उनको चूज करके आप सिलेक्ट कर सकते हो फंड. डॉक्टर अनुपम, यू वांट टू ऐड समथिंग?
I think I think if people can ask questions, or otherwise we can discuss what are the criteria that Wilcon Dr. Ram has suggested for us to go for. So if we can repeat, first is, so it is the CAARESA criteria, where first is we decide the category of the fund, right? So where we want to invest, whether it is large cap, mid cap, small cap. So whether we want first in, so this is basically for equity funds, right? It doesn't work for ETFs. So there are another one thing is, which is known as exchange traded funds or ETFs. So mutual fund like we all say, there are mutual funds. So most of the mutual funds are not traded on exchange. There are only few funds which are traded on the exchange, right? So those are known as exchange traded funds. And basic thing is, when we are selecting a fund for our investment, we are trying to be invested, like Dr. Harpal also emphasized last time. The investment is not for a duration of 6 months, 1 year. We are investing for over a longer term period, which is mostly we take around 5 to 7 years. And when we go for that, so first we should decide the category that we are trying to go for. The category Dr. Vishal had said in equity can be large cap, mid cap, small cap, or mixed, where we can flexi cap, where it is they can, so the difference between large cap fund, mid cap fund, and small cap is based on their percentage where they invest in. So if it is more than 60% in large caps, then it means it's a large cap fund. If it is more than 60% in mid caps, it is a mid cap fund, right? So there, the question is, another question is where to invest, whether large cap or index fund. So best is to invest, like Dr. Vishal had also said, large cap is a more stable fund. So if you want more stability, go for a large cap. If you want more returns but at a higher risk, then go for a mid cap or small cap fund. So based on, he had given you a chart where, or a pyramid where majority 50 to 60% is in large caps, next is mid caps, and the next is small caps. So that way you will have some percentage in growth, a higher growth, some, mostly you will have stable thing at 50, around 10 to 12% in 50 to 60% investment. And so that is based on the category of fund. Then age of fund. Age of fund, it should be, at least why we are talking about age of fund is it should be a reliable fund. Means it is not newly just come up. The fund manager, we don't know who he is and who has been allotted and how he or she will take care of our money. So the age of the fund, that means it has a proven track record. So what we say is approximately it should be more than 3 years, if not less than 5 years. Why? Because we are seeing at least 5 year returns of any fund. So the fund has to be 5 year, at least minimum 5 year old fund. Then the AUM, which is asset under management. Now, asset under management, when we say talk about is, it should be at least 1,000 crores. Means that the people have the faith in that AUM, because see, everybody is in, those who will invest. So people are all smart. So if the AUM is good, that means people have the faith in that fund and it has some performance. That is why it has a good AUM. So that is another criteria. So first we go for category, second age, then the asset under management. Then we talk about the returns. When we talk about returns, we see the 1 year return, the 3 year return, and the 5 year return, like Dr. Vishal had said. Now, in this, I will just add on to it that one is the 1 year, 3 year, and 5 year is a point to point return. Means you invested at one point of time, 1 year back, and we are seeing the return now at after 1 year. 3 year point to point is we invested money 3 years back, one investment, and 3 year CAGR. Means the difference between CAGR and XIR or IRR or XIRR is CAGR is one time investment. You have invested now, and we are seeing what will be the return after some time. That uses the formula of the compound interest, which is P is equal to the A is equal to, which is amount is equal to P into 1 plus R over 100 raised to power n, that we all used to learn in mathematics. So based on that, so that is CAGR. XIRR is when you invest in SIPs or regular investments. That is, if you are putting regular investment, it is IRR. If you are putting investments plus you are adding on to it, then it becomes XIRR, or internal rate of return and extended internal rate of return. So when we talk about returns of a fund, we talk about the point to point returns. So 1 year, 3 year, and 5 year. Also, Dr. Vishal, if you can just show them returns. If you click there, there is the option of SIP returns. So we also look at the SIP returns, because the point to point may vary with SIP returns. So when we see the SIP returns, just in returns only, you will see tab there and you will find the SIP returns.
Yeah, SIP returns.
Right. So if you click on the SIP returns again, so what we try to do is we are trying to make a list of the top 5 funds. In each time we see the return. Right. Every time that we see the return, we are trying to see the thing. We are where we, after that we try to get the top 1 or 2 or 3 funds, and then we invest in that category in those funds. That is how we do it. That is the simpler way. The expense ratio, we see the expense ratio. Now we have got those 5. We'll see the returns, plus we'll also see the expense ratio. So expense ratio should be minimal, because if the fund has a higher expense ratio, the chances are your money, whatever is being invested, is being, so all the expenses which are like the fund manager's income, his salary, and all the other expenses of the mutual fund are going into it, including the advertisements and everything. So we don't want those expenses to be higher. So overall, when we see this scenario, we select then 2 or 3 funds. There are other ratios which are Sortino ratio and alpha ratio, which we may skip for now, but it is available. Dr. Vishal, you can just show them what is solved, where it is there, Sortino and alpha ratio.
I can show them.
Sorry,
I will show them.
just
The
in
Timo
the
ratio is
returns.
basically if a fund is generating 18% return and in the year there was 10% downfall and the FD return is 7%. So 18% return of the fund minus FD returns and divided by the downfall. So 18 minus 7 is 11 divided by 10% 1.1. But if a fund is showing only 5% downfall in the year, the market will go up and down. So 18 minus 5, 13 divided by 18 minus 7, 11 divided by 5, that is 2.2. So higher Sortino ratio is better because the downside of the fund is limited in that way. So fund manager is able to protect the money and is not allowing the fund NAV to go down.
Yeah. So basically, one is that the alpha will tell you how it is performing in relation when the market is going up, how much returns it will give you in relation to that market. That is alpha. Just for simplicity, alpha ratio, and Sortino ratio is when the downfall happens, how much it is protecting your money from going down. So higher, both are, if higher are better. So those are alpha and Sortino ratios for ingest. So once we see that, so I hope everybody is clear on how we select a mutual fund.
Any questions or difficulty in selecting the mutual funds, please you can try now also. Even in 2-3 months, you can easily select the mutual funds, which are top 3 for mutual funds. And you see the expense ratio and the asset under management. Higher asset under management will be selected, and among those, if the expense ratio difference is very high, like here, if you see, you can see my screen. The top 2 funds have a difference, quite large difference. Expense ratio is 0.87 in the top fund and 0.65 in the second fund. And if the return is marginally different, I will choose the number 2. Is it clear?
There is a question, any upper limit for fund AUM?
No, there is
Dr.
no
Vishal.
limit. Like Prague Parik, FlexiCap is having a asset under management around 90,000 crores. So there is no upper limit.
So the question was actually that do we need to look at the upper limit? Like, should we remove any funds who have maybe 1,000 crore or more than that investment already in their that when the AUM is already more than maybe 10,000 crores, or should we remove the funds which have their asset under management more than a certain value? Should we ignore those funds, or it is always the higher the better?
It is always higher the better. No, it's not higher the better, but we need a minimum criteria to invest. Well, it should not be running away with our money. We don't want that. But if a fund with a higher AUM is giving you more returns, at the end of the day, we want only returns with a lesser expenses.
So Dr. Anupam, I will give it, explain it with an example. If 2 funds are giving me 17% return, both are giving me same return, 17% return. And AUM under one fund is 50,000 crores. AUM under the other fund is 2,000 crore. So I will choose the fund of 50,000 crore because that will be more stable, and in long term the chances of it being able to perform are higher. Any comment by Dr. Harpal?
I have a question. When do we exit a fund? So what are the indication that if the fund is not doing well? So when do we, what are the indications? How do we select that to exit from a fund?
So, sir, as we said in the beginning, when the question was asked about change, right? So, if the fund is not performing consistently, or suppose we invested according to whatever we selected, the criteria we selected, and we now invested, but we'll keep tracking at 6 months or 1 year and see how the fund is performing. So, again, we'll be doing the again analysis after 6 months and 1 year and see how it is performing against other funds of the same category. So, if the fund is doing reasonably well, we'll not we'll continue with the same fund. But over a time period, if we find that the fund is deteriorating with time, or if there is a news with the fund manager, and then we'll try and see what is happening inside. If there is something going wrong with the fund manager, or the fund manager has changed, so if all those things are having a problem, that is the time to exit from that fund. But the first criteria of exiting any fund is no regular funds. So in the group, around 40 people had said they are invested through a regular group. So in that scenario, immediately we should exit from that regular fund and try and take a direct fund. Now, the basic problem of taking a regular, why we take the regular fund is we are not in the knowledge of how to select the fund. So in today's presentation, Dr. Vishal had shown you how we select a fund which is going to do well for us. I hope that answers the question. Dr. Anmil sir
It
is
seems
saying,
that there's a lot of interaction in this webinar. So one point that was being discussed about the AUM, take it with a pinch of salt. But the funds where the AUM is really huge, it's difficult for the fund manager to give equivalent returns what he's been giving in the previous years. The reason is, just imagine a fund which is now 100,000 crores, and he says, I will invest 2% in Reliance. Now just imagine 100 lakh crores, the 2% is how much? If he puts that money in the Reliance, the whole Reliance price action will get disturbed. To generate returns becomes very difficult as the funds, as the AUM keeps on increasing. But all said and done, that doesn't mean that it cannot be done, but it becomes very difficult for the fund manager to manage. That is why it has been seen, when you see historically, that the funds which become super favorite of the retailers, they slowly start having their returns start getting plateau rather than increasing returns year on year or something. The other thing that I wanted to ask was, Dr. Vishal.
Yes, sir.
The point is, we were talking about alpha.
Yeah.
It has been observed that over a long period of time, is it possible to time the market?
Sir, timing the market is very difficult. बहुत टाइम लोग सेलेक्ट करते हैं कि मार्केट गिरने वाली है, मैं बेच देता हूँ, सस्ता खरीद लूंगा. इसको एक्यूरेटली टाइम करने वाला लाखों में से कोई एक होता है. मोस्टली लोग मिस ही करते हैं अपॉर्चुनिटी. सो मैंने भी अपने एक्सपीरियंस से देखा है, ओवर एक्टिविटी लीड्स टू लॉसेस. आप सिलेक्ट करो, टिके रहो, अनलेस कोई स्पेसिफिक आपको हिंट मिलता है कि जो आपकी इन्वेस्टमेंट है उसमें कोई स्पेसिफिक रीजन है कि ये परफॉर्म नहीं कर रही, आपको बार बार शिफ्ट करने की जरूरत नहीं है।
Now, coming back to the main question, if it's not possible to time the market for a common person or for routine people, or you say 1 in 1,000 or 1 in 1,000,000 would time the market, then does it make sense to pay higher expense ratio and put your money in actively managed funds rather than a passive index-based funds?
Sir, we need to see the performance of the fund. That the charts are easily available on value research. If the index fund is performing according to the Sensex, you need to compare the return of the Sensex with your fund. If your fund is actively giving you 3 to 4% more than the index fund, then you stay in that fund. But if it
But
is not able to beat the index,
if the moderator can allow, I would like to add something to this point with permission of Dr. Anupam.
Sir, go ahead, please. It's
Yeah,
just a
please go
discussion.
ahead. Please go ahead.
Actually, what Dr. Harpal wants to ask and wants to enlighten everyone, correct me if I'm wrong, Harpal sir. Actually, it has been seen then that when we are selecting large cap funds, primarily, the most of the blue chip or the large cap funds are not giving more returns when we compare them to a index fund, what we call a Nifty 50 index fund or a Nifty Next 50 index fund. In the last year, if I mean to say, I checked it in 2022 and 23, only around 7 out of 21 blue chip funds could outperform the index fund, and where the expense ratio is too much as compared to the index fund. Definitely, when we are discussing about mid cap funds or small cap funds, there most of the fund houses are able to beat the indexes by and large. But specifically, when we discuss about large cap funds, then the index funds are definitely better because as there is no one actively managing the funds, so the expense ratio is very less. So for me, when I'm selecting funds, so the criteria is completely different when I choose my large cap fund, because I have to choose an index fund, and there I have to see not only the expense ratio of the fund but also the error in tracking error of that fund. So definitely, as Dr. Vishal has mentioned, when we select your mid cap funds or small cap funds or multi cap, flexi cap funds, then definitely these criteria do fit in very well. But specifically, I'm talking about large cap funds. Definitely, the index funds are better, and I would like Harpal sir's feedback on this.
Dr. Rahul there.
Yeah, Mohit, you have hit the nail on the head. Absolutely. When you talk of large cap funds, this year you were able to see from 2023, these 7 funds have outsmarted the index. But we talk of rolling returns in mutual funds. Those are
Definitely, sir.
point-to-point returns
Yes.
over a fixed period of time, right? So when we go back, this is called survivorship bias. If you go back 10 years, there may be other funds which were the leaders. Over next 5 years, different are leaders. So they keep on revolving. But when you look at 20-year period, none of them has been able to beat the index. When I say this also holds true for small cap index, for mid cap index, for mid small cap index, which is Nifty 450. Right? Leaving the first 100 out, they are mid cap and small cap 450, which are included. So that's also true, but let's take it with a pinch of salt. The message should be clear. We have to be in the direct funds. We have to follow a proper method to choose the funds. And if you understand it well, index funds are a way to go to keep your expense ratio down and to have reasonable returns based on the index, because Nifty would never go to zero.
Absolutely.
Right? Similarly, Nifty 50 is never going to go zero. Nifty mid cap is never going to go to zero because some companies will go out, some companies will keep on coming back. But we also have stellar performance from funds like uh, Parag Parekh, who have beaten Quant. So I'm not against actively managed funds, but keep a check on the expense ratio to not to bear all the burden. That's how I call it for the uh, fund house. And the other thing that I will like to highlight here is the skin in the game. Please check, are the people of the fund house, the fund manager, investing in the same fund? Let me give you an example like Prashant Jain is a star fund manager, for HDFC. And he gave some stellar results for many years. And then for next few years, his performance was below average to the extent that he was getting criticized left, right, and center. It was just like a football on every discussion ki Prashant Jain is failing, Prashant Jain is failing. But he had his life savings in the funds that he was managing. So you at least knew that, okay, this guy is not playing pool with us. His own money is in the same fund. So, Dr. Vishal, can you tell us how to check about the fund manager, how they are investing or are investing in the same fund that they are managing?
Sir, usually we get emails regarding what all stocks your mutual fund is buying. And you can get on the net also what all is invested by the fund manager. The holdings of the fund managers can also be checked. And you can compare the holdings in both the क्या कहते हैं sheets. But I सर डॉक्टर हरपाल मेरे को ये नहीं पता कि फंड मैनेजर उसमें इन्वेस्ट कर रहा है कि नहीं, ये कहाँ से मिलेगी रिपोर्ट?
What I feel is he's absolutely right. It's matlab, if we could that do that much of research, then why would not we be investing in direct stocks, right? So itni detail to dhoondna I think needs a lot of time. It is not like it is not possible, but definitely what an individual can do is he or she can definitely keep a track of the fund he is investing in at least yearly, so that he does not lose the pulse that what if I'm investing in say Parag Parikh flexi cap fund, then I have a list of top 5 performing funds as has already been told the Carissa criteria, and I can see if my fund falls in those top 5, right? If it is losing out on that, then maybe it is the time to change the fund, not the category. Let me be very clear about it. It is the time to change the fund, like someone also asked. But looking like कि fund manager कहाँ invest कर रहा है, I think it needs a lot of dedication and lot of time to search for that. And had we got that much of time, maybe we would be investing more in direct stocks than looking for mutual funds. This is what I feel about it.
Can I add two things here? I think we were discussing about index funds. So index funds, those who are aware, it's okay. But there are two types of funds. One where passive funds, and the other is actively managed funds. So passively managed funds are index funds. So example is an index fund where the fund manager has no role, not much of a role. They are just tracking the index that they are following. So like you have a Nifty 50 fund and maybe a Sensex fund. So you have or a junior Nifty fund. So when you have these funds, they are just the composition of the shares that they are buying or equity they are buying is similar to what the index composition is. So that is why they don't have any active management. So that is why the expense ratio is lower. So as we had discussed in one of the criterias, we need funds which have a lower expense ratio. And because of this, many index funds perform on an average over a long-term period better than an actively managed funds. So it is always a good idea if you can have if you have no idea, just to invest in a Nifty index fund and or a Sensex fund, depending upon what is your preference. Now, the KRSA criteria do not apply for these funds because these are Nifty, they are tracking just the index. So here the criteria is to see the tracking error. So tracking error is basically whether the whatever the fund is doing, whether it is mimicking exactly what the, suppose it is a Nifty 50 tracking, Nifty 50 fund. Is it exactly mimicking what the Nifty 50, how it is performing, or is it lagging, or there is some different discrepancy between that? Now that is known as tracking error. So that we can get tracking errors also we can get on the net. So that is for a passively managed fund. Now passively managed funds again are of two types: those which can be traded on the exchange, which are known as ETFs, exchange traded funds, and those which cannot be traded on the exchange. So these are the normal index funds. That is one. The other is, I think there is a question on fourth percentile or how, when to get out. I think Dr. Ramneek had put a question which said uh, about fourth percentile. Am I correct, Dr. Ramneek, if you're still there? Hello. So fourth percentile is when, again, it's similar to like you see the returns of all the funds, and if it's like 90, if not, it is less than if 96% of the share of the funds in that category are performing better than your fund, then you definitely exit. So rather than reaching the fourth percent, that is a definitive indication, like we have for definitive and absolute and relative indications. That's an absolute indication for exiting the fund if it is not performing even in the top, it is the bottom four on your list. So that in that criteria, fourth percentile is an absolute indication for an exit. Dr. Mandeep had said there is no actively managed index fund. They are all passively managed. Index funds are all passively managed.
सर डॉक्टर हरपाल का जो क्वेश्चन था ना कि वो फंड मैनेजर कितना इन्वेस्ट कर रहे हैं, the SEBI has mandated for all the fund managers to invest at least 20% of their annual salary in the schemes they manage. SEBI has come up with the new regulations so that they have some transparency कि मैं भी इसी फंड में मेरे को एटलीस्ट 20% अपनी सैलरी इन्वेस्ट करनी पड़ेगी, सो उसकी डेडिकेशन बेटर रहेगी उस फंड के प्रति.
Thanks, Vishal, for bringing this out. That is what the answer I was looking for.
So that's I've searched now.
Before this regulation also, Prashant Jain had close to 100 CR in his own funds. So Dr. Sood wants to ask something.
So what about Nifty 50? There are various Nifty 50s like UTI Nifty 50, Data Nifty 50. So which one of these is better? So how to select that?
Sir, the one with the least tracking error is the best.
Also, sir, the
least tracking error and
age,
least expense ratio. These two criteria are there.
age of the fund also matters, I think, when we are selecting our index fund. The age, the tracking error, and definitely the expense ratio.
One thing more about the age of the fund. Any fund that comes into the market, NFOs, the first year expenses may run up to 5 to 6%. Otherwise, we are saying expense ratio is 0.5 to 1% of actively managed funds. But NFOs starting में advertisement, commissions बहुत ज़्यादा होती हैं. So NFOs are not to be preferred. फंड को थोड़ी देर चलने दो, साल दो साल चलने दो, एक तो परफॉर्मेंस पता लग जाती है और फर्स्ट ईयर के जो ओवर एंड अबव एक्सपेंसेस होते हैं उससे आप बच जाते हैं.
So that is why in that scenario, Dr. Vishal, I would just differ from the closed-ended fund, which you said that closed-ended fund may perform better because you cannot exit. But closed-ended funds are mostly all NFOs. So better to avoid all NFOs if the take-home message is again the same. Please do not invest in a new fund offer. NFO is a new fund offer because the expense ratio is very high as compared to a fund which is regularly doing its work over last 5 years, and we are not sure of its returns.
Sir, as Dr. Mohit told about index funds, so if you want to keep it simple, कोई बहुत ज्यादा रिसर्च आपको जैसे वैल्यू रिसर्च मैंने करके दिखाया नहीं करनी है, इंडेक्स फंड्स में रहो, यू विल गेट decent good returns without any serious research required.
See, at the end of the day, the idea is to beat inflation and reach your goal. And if your goal is to build up money or make more money or let your money only work for you, make more money for you, then you have to keep beating the inflation. So anything which is giving you 7% or less is not a good recommendation. Anything a nifty CAGR is around 10 to 12%. So that is why even if you invest in a nifty index fund, you can easily say it is around 12%. Sir, Dr. Ravinder Sadhu is asking what is the goal for a decent return? Sir, goal for a decent return depends upon what is your final goal. How much money is finally required for you? If you and how much time is remaining in that. So based on that, everybody has a different race to run. But we need to be very sure that we are not we ऐसा नहीं है कि हम we are going from Delhi to Mumbai and we मतलब तेज दौड़ाना लगे और पहुंचना था and we reach Haridwar. So we should avoid a very aggressive approach. Just be like we are all everybody is suggesting here. Maybe just plain index funds is good enough at 10 to 12% a year, because a common formula that we use is uh, 72 divided by the number of the rate of return is the amount your money will double in that many years. So suppose your return is 12%, the money that you have put in that particular thing for one CAGR is, so it will double in 6 years. So that's a rough idea. So somebody's question is how to shift from regular fund to direct fund. Dr. Som, there is no shortcut to it. You have to sell all your regular funds, and if you are happy with the performance and if you have used your selection criteria clearly, you can put in them in direct the same day or the next day. So if you put in the same day, suppose you have money in your bank. So suppose you have 2 lakhs invested in your mutual fund, which is regular, withdraw that 2 lakhs. So you put your this, so that will be coming by the end of the day. The same day you can put 2 lakhs in the same fund from your bank account. So as the direct mode. So that is the only, I think that is the only way. Other ways are there, STP and all those things, but they don't normally work. Switching doesn't work. This is the easiest and the short way. You withdraw from there and put money directly in your regular direct fund.
Also, sir, there is I think this question was asked in the chat, also in the WhatsApp group. There is an app by the name of IND Money. It actually works very well. Even I have done it myself. In a single click, they themselves shift all your funds from regular to direct. Plus, they also give you the exact expenses which are going to occur, including your tax liabilities and all, when once you do it. So the way Dr. Anupam has told, it is definitely the best way to do it. But I think you can go and check IND Money app. It is one of the apps which can be used to invest in US market directly also. So, and it is a safe app, SEBI approved. So no chances, or maybe I say very less chances of fraud in that. So that can be looked into. It's a very easy way if you are not too much savvy into investing directly to a mutual fund house. So that apps definitely help you.
I'm not aware of this IND money because if you do that, then you are putting all your money in IND money. Although it may be SEBI registered,
No, sir,
whatever.
it tracks the way we track in value research, right? जैसे value research हमारी सारी
It is
investment
difficult
track
for me to understand that how will it shift if the mutual fund house is not allowing it to switch. So then it doesn't have your money. Means you are not whatever is investing. So it may be doing something. I'm not sure, but
maybe I'll also check into the details, sir. But
because
like
the
coin
only
works,
way is to
like
redeem your
Grow app
regular
works.
plan.
Yeah.
The only way to is to redeem your regular plan and reinvest in a direct plan. And this, if you're happy with the same direct plan, the same fund, put in the direct plan. And an alternative is to switch in the same fund house. Well, some platforms might offer that. But again, it is the same thing. Even if you do use IND money, taxation is going to be the same.